cherry pick a question here to kick us off today because I thought this was kind of interesting, and I think a lot of people maybe struggle with this. I'm going to mispronounce the name, but it's Amabilis Castillo from Caracas. Good morning, gents. I'm having problems with my portfolio diversification construction. Currently, I'm holding more than 100 names and overall beta is high. How can I construct a better portfolio so weeks like this don't impact me so much? And what number of tickers are the most efficient way to hold? So just this concept that you kind of own everything, right? So basically, your exposure becomes the market, and it could even be higher beta if you're skewed towards higher beta. But what kind of advice or input would you give him, in terms of transitioning over time to, I guess, a more effective portfolio?
Well, I think one part of the answer that people might think is the answer, but it's the opposite of the answer, is that you reduce the number of names. If you reduce the number of names, you could amplify portfolio volatility. Portfolio volatility is amplified by concentration. So, in other words, if you have 10 names, if say you're running $100,000 of your own money, and you have $10,000 positions, 10 of them, you're going to have a lot more beta than the guy that has, again, 100 positions. So I think you've done one thing there that's good. I mean, high beta, hopefully you're not having like a panic attack on that. High beta up until yesterday, which was flat to down, has been one of the best factor exposures you could be long. So you've made a concentrated, a conscious bet to both diversify and be long high beta. That's a very good decision. Like, that doesn't mean being long high beta doesn't mean high beta doesn't work because it's high beta, right? Yeah. So, I would guess that, we have a happy subscriber from Caracas because being long high beta has been where it's been at. So again, consciously take on factor exposures. If you want to hedge that because you're like, wow, I got too much high beta, then buy a bunch of low beta, but you're going to lose money on it. Those are our shorts.
Yeah. Okay, we're going to go back.
I have, just as a matter of reference point on the number of positions, I'll run between 30 and 50, usually. And okay with that. The only thing that's annoying with that is that I have to spend more time during the day trading because I touch all the positions. Yeah. So, but it's hard work, right? It's just like my dad giving me the tar bucket to go, tar the bottom of a basement on a new house we're building, and life's not easy, so if you want to do better, you got to work harder. And if you work harder and you have more names, it's a harder work than just buying an index. Then it's going to be harder work. And I bet that you'll be happy with the results associated with working harder than other people.
Yeah. I think actually it's interesting that you say between 30 and 50. I've looked at this, and a lot of, and diversification is a way to protect yourself, to Keith's point. So if you're very concentrated, you have more drawdown risk. So diversification, works in that regard in terms of protecting from the drawdown risk. And what a lot of studies show is that sort of the max diversification you need is about 40. That gives you sort of all the protection you need from that, which is kind of where Keith is sitting. So maybe that's sort of a number to think about, getting it down to 30 to 50, and making sure you have the right quad-oriented factors and bets on.